Financial markets. That phrase alone can sound pretty intimidating, right? But really, when you strip it all away, it's just a giant matchmaking service for money. On one side, you've got people with savings, and on the other, you have people with big ideas that need cash. So let's break down exactly how this whole system connects the two.
So here's what we're going to cover. We'll start with the big why, the whole purpose of financial markets. Then we'll get into the two main types. After that, we're going to walk through what actually happens when you click buy on a stock, meet the market's all-important referee, and finally, tie it all together to see how this system fuels the entire economy.
All right, let's dive right in. At its very core, what's the big problem that financial markets are even here to solve? Well, it's this fundamental challenge. On one hand, you've got people, maybe like you, who have some savings and you want that money to do something, to grow. And on the other hand, you have entrepreneurs, innovators with these fantastic ideas that could change the world, but they need funding to get off the ground. So how do you connect those two groups efficiently?
And that is exactly where the financial market comes in. Think of it as the essential bridge, the economic engine that takes the savings from households and channels it directly to businesses that can put that money to work, fueling everything from innovation to job growth. Now, this incredibly important job has a bit of a formal name, the allocative function, but don't let the jargon scare you. All it really means is that the market acts like the economy's brain. It's constantly working to send money not just to any opportunity, but to the most promising ones. It ensures the best ideas get the fuel they need to succeed. Okay, so this market isn't just one single thing. The first and most important way to slice it up is by time. Are we talking about short-term needs, or are we talking about long-term ambitions? It pretty much breaks down like this. The money market is all about short-term borrowing and lending. We're talking less than a year, sometimes even just overnight. The capital market, on the other hand, is for the long haul. This is where you go to fund huge, multi-year projects like building a new factory or developing a new technology. And these differences have some really big consequences. In the capital market, you find all sorts of participants, including regular retail investors like you and me, buying things like stocks and bonds. The money market, though, that's mostly a playground for the big guys, like banks and the Reserve Bank of India. It all boils down to that classic trade-off. The capital market offers the chance for higher returns, but with more risk. The money market is much safer, but the returns are generally lower. So let's zoom in on the capital market for a second, because that's what most of us think of when we hear the market. But even within this world, there's another super important distinction. And honestly, the easiest way to wrap your head around it is to think about buying a car. The primary market is like the car factory. It's where a company creates a brand new security like a stock and sells it for the very first time to raise money for itself. Now, the secondary market, that's your used car dealership. It's where investors like you and me trade those already existing securities among ourselves. The original company, it's not involved in these transactions at all. One of the biggest differences is how the price is set. In the primary market, it's a company that decides the initial price. But in the secondary market, it's all about good old supply and demand. And here's why that secondary market is so absolutely vital. Even though it doesn't directly put money in the company's pocket, it provides something called liquidity, which is just the confidence that you can easily sell your investment whenever you want. Without that confidence, way fewer people would be willing to invest in the first place. So, let's get practical. How does a trade in that secondary market, the stock exchange, actually work these days? You might be surprised by how simple and fast it really is. First off, it's just amazing how much things have changed. We've gone from the old open outcry system. I mean, literally picture people in a crowded room, shouting, using hand signals to make deals, to today's quiet, efficient, screen-based system where a computer matches buyers and sellers in a fraction of a second. It's made the market way more transparent and accessible for everyone. And here's the whole process, step by step. First, you get set up with a broker and open your accounts. Then, you place your order, telling them what you want to buy or sell. Instantly, their computer connects to the exchange and finds a match. You get a legal confirmation, and just 2 business days later, what's known as T+2, the shares officially land in your account and the money is paid. That's it, from your click to actual ownership. Now, the secret ingredient that makes this whole seamless process possible is a big word, dematerialization. But really, it's a simple concept. It's just the process of getting rid of all those old-school physical paper share certificates and turning them into electronic records in a special account called a demat account. This one change eliminated massive problems like theft, forgeries, and just mountains of paperwork.
So who's holding all these electronic records? Institutions called depositories. You can just think of them like a bank. But instead of holding your cash, a depository holds your securities, your stocks and bonds. In India, the two main ones are NSDL and CDSL. They're the silent, invisible backbone of our entire modern trading system. Okay, so you've got millions of people and literally trillions of rupees flying around electronically every single day. You can probably imagine, you need a powerful, tough referee to make sure everybody is playing by the rules. In India, that referee is SEBI, the Securities and Exchange Board of India. They are the top cop, the ultimate watchdog for the entire securities market. Now, SEBI wasn't just created out of the blue. Back in the 1980s, the market was kind of the Wild West. You had all sorts of problems like people manipulating prices, massive delays in getting your shares, and just a lot of unfair practices that were shaking people's trust. So the government realized it needed a strong, independent regulator to come in, clean things up, and protect the average investor. At the end of the day, SEBI's entire mission really boils down to three simple but powerful things. Regulate the players to keep things running smoothly, protect investors to make sure they're treated fairly, and prevent fraud and manipulation. Pretty much every rule they make serves one of those three goals. Okay, so we've seen all the different pieces of the puzzle, the different types of markets, how a trade works, and the regulator watching over it all. But now let's zoom back out and connect the dots. Why does this whole complex system matter so much to you, me, and the broader economy? Well, a healthy stock exchange is an absolute economic powerhouse. It provides that liquidity we talked about so you know you can get your money out when you need it. It helps figure out the fair price of things through constant buying and selling. It funnels money into businesses, which helps the economy grow and create jobs. And by being so accessible, it encourages a culture of investing, allowing way more people to share in the country's success. And really, if you remember just one thing from all of this, let it be this. The entire point of this whole system is to make sure that a country's savings get channeled into their most productive investment avenues. It's about putting our collective money to work in the smartest way possible. You know, the evolution of the market from shouting traders on a floor to silent algorithms in a data center has been just staggering. And as technology keeps making everything faster, smarter, and more accessible, it poses a really fascinating question. What's the next big disruption in finance going to look like? What's just over the horizon?